Imagine a world where every real estate decision you make is fueled by clear, insightful knowledge. We are growthsense.com. We built a platform that allows investors to buy, sell, and invest in real estate properties of all kinds, in all shapes, and in all conditions. What if I told you that understanding profit margins could be the key to unlocking tremendous financial potential? For investors navigating the unpredictable waters of real estate, a 19% profit margin stands as a beacon of opportunity, guiding them toward maximizing their returns. Let's dive into the significance of this profit margin. A 19% profit margin means that for every dollar invested in a property, an investor anticipates earning 19 cents after all expenses are accounted for. This crucial figure helps investors gauge potential profits against other investment options. For example, if you purchase a property for $100,000, a 19% margin would suggest you aim for a profit of $19,000 after expenses. This percentage not only aids decision-making but also enables comparisons across various property types and market conditions. Now, let's explore 7 key insights that can deepen your understanding of a 19% profit margin in real estate. Number 1. Grasp the basics of profit margin. A 19% profit margin indicates expected earnings of 19 cents on the dollar after covering costs like purchasing, renovating, and selling a property. Understanding this concept lays the groundwork for evaluating potential returns and setting realistic financial expectations. Number 2. Recognize the impact of property types. Profit margins vary significantly based on the type of property. Retail properties typically yield higher margins than office or industrial spaces. Focusing on more profitable property types can enhance your investment strategy. Number 3. Ensure accurate calculations. To assess profit margins accurately, calculate net profit by subtracting all expenses from rental income. Many investors overlook critical costs, leading to inflated profit margin calculations. Keeping precise records and updating financial projections can support sound decision-making. Number 4. Compare real estate with other investments. When looking at a 19% profit margin, it's wise to compare it to other avenues like stocks or bonds. Historically, real estate has outperformed the S&P 500's average net profit margin of 7.7%. This perspective allows investors to evaluate the strengths of real estate as a long-term investment strategy. Number 5. Be aware of market sensitivity. Profit margins fluctuate with market conditions. Economic shifts can affect property values and rental demand, impacting expected returns. Staying informed about economic trends allows investors to adjust their strategies wisely. Number 6. Use profit margins for comparative analysis. Analyzing profit margins across different investment opportunities helps identify the most promising deals. This analysis should consider property types, locations, and market conditions to ensure smarter investment choices. Number 7. Integrate additional metrics into your evaluations. While a 19% profit margin is essential, it should not be the sole consideration when assessing an investment's viability. Factors like return on investment, ROI, and cash flow are equally critical. A strong profit margin combined with positive cash flow reflects a robust investment strategy. Calculating profit margins is vital for understanding how much money can be made after covering property-related costs. To find the profit margin, start with net profit, rental income minus all expenses. Divide that figure by total revenue and multiply by 100 to get a percentage. For instance, if you generate $50,000 in rental income and incur $40,000 in expenses, your net profit would be $10,000, resulting in a profit margin of 20% unit. This calculation is crucial for assessing financial health and comparing investments. When comparing real estate profit margins across different types, significant differences emerge. Retail properties typically boast an average profit margin of around 28.7%, while office properties average about 16.5%, and industrial properties sit at approximately 10.8%. Understanding these distinctions helps investors prioritize their investments according to financial goals. Several factors influence these profit margins in real estate. Market conditions play a crucial role. Employment rates and consumer spending directly affect property values and rental demand. Location matters immensely. Properties in high-demand areas often yield better profits due to higher rents. Management efficiency impacts profitability as well. Properties that are well managed tend to have lower vacancy rates and operational costs. Renovation and maintenance costs must be carefully budgeted. Underestimating these can strain finances significantly. Financing terms also influence overall costs. Lower interest rates lead to smaller mortgage payments and enhanced cash flow. Understanding tenant demographics can help align properties with market demand for higher occupancy rates and rental prices. Finally, the regulatory environment can affect profitability through operational costs and rental pricing regulations. Changes in laws can create uncertainties that impact profit margins over time. Staying informed about these changes is essential for effective investment planning. Exploring distressed properties offers investors a chance for lucrative opportunities that can transform their financial landscape. Distressed properties, those facing foreclosure or needing significant repairs, can yield impressive returns after renovation. For example, an investor purchasing a distressed property for $100,000 and investing an additional $30,000 in renovations could sell it for $180,000, thus reaping a $50,000 profit. Resources like growthsense.com empower investors by providing tools to identify distressed properties and assess associated costs and returns. This platform offers insights into local market trends and renovation costs, enabling informed decisions that lead to profitable investments. As we wrap up this journey into understanding a 19% profit margin in real estate, consider how this knowledge could reshape your approach to investment decisions. The world of real estate is filled with opportunities waiting to be explored. Each decision could lead you closer to financial success or back into uncertainty. What if the next property you invest in could change everything? Stay vigilant. The market is always evolving, and with it comes new opportunities for those prepared to seize them. Visit growthsense.com for invaluable insights that can help you navigate this dynamic landscape and make informed choices for your investment future.